We'll do it live.
Okay.
We'll do it live. F it. Do it live. I'll write it and we'll do it live. F***ing thing sucks.
Yeah.
All right, welcome back to the Capital Mindset live show. Hope you guys are having a great day as always. Today we're going to be talking about the following topics listed in the title and down below in the description. So with that being said, I think we have a topic that might be, we'll save this. I'll start because I can star these and we can come back to them later. But we definitely need to talk about that. All right, but anyways, MPW, Bacon, why you long?
I'm not.
Okay. Well, Andrew, why are you long?
I think the assets are undervalued and it's worth $15.
All right. Jesse, why are you long?
I followed Andrew.
Okay. So
Fabio, why are you long?
the book value.
You, the viewer, why are you long MPW?
Okay. So, yeah, we got some discussion to have about MPW, which has become, would you say it's a retail favorite yet or no? I think it's pretty popular here on YouTube. Or at least it was. I don't know if it still is. There were plenty of YouTube videos coming out before about MPW stock, but it's definitely heated to say the least. There's a lot of opinions on both sides. I want to start by saying some of the short people, I don't really think they have good ideas. I'm talking about a particular Reet Bob guy who is long WeWork, pounding the table, also short idea in Iron Mountain. And this is his third idea that I'm aware of. So he's 2 for 2 as a loss. Maybe this won't be his one win that I know of, at least his high conviction plays. So let's begin by talking about its performance and kind of give everyone the background. So MPW, what you need to know. I thought you were going to stop naming YouTubers, brother. Never said anything. I can do whatever I want. So Medicals Properties Trust. And I don't think I named a YouTuber. That's not even a guy on YouTube.
Yep.
So this company, if you go back in time about 5 or 6 years ago, this was considered a very safe REIT. The concept behind it is you're investing in healthcare properties, and thus that adds another element of safety. Also, say Bob.
Just please continue.
Yeah.
Not worth the attention.
But anyways, Medical Properties Trust has been typically considered in the past one of the safer REITs to invest in due to the property type. I've usually given the analogy about the property type being a double-edged sword, hospitals being something that is very difficult to replicate. So once you have a hospital, there's not much you can do with the property besides have a hospital operator in it, similar to like a Vici Properties or a casino type property. So like, Caesar's Palace, it's not as restricted because Caesar's Palace, what can you put in Caesar's Palace without tremendous CapEx? Probably the brand Caesar's Palace operator. Same with the Venetian. Unless you do an incredible amount of CapEx, that property is going to be best suited for an operator with the brand of the Venetian. So likewise, but to a lesser extent, a medical operator is probably the best suited for a hospital. It would take a tremendous amount of CapEx to transform that property into something else. So that being said, that also means that you do have a bit of staying power if the properties are located in a well-situated place. Now, a lot of the MPW bulls kind of investing in it in the now are pointing to a few factors as to why it might be undervalued. One of the reasons is the book value or the price to book. The price to book is nearing an all-time low because we're not technically at the lowest point it was ever at. I think that was at $3. So we're about $1 away from hitting that. And that at that point, I think the price to book maybe hit like 0.2 or 0.3, something like that. So on the surface, it looks really cheap if you don't really dig far beneath the surface there. There's some problems using price to book as a valuation metric. It's decent as any other surface level metric might be, but we'll kind of break that apart a little bit here and talk a little bit more in detail as to what are some of the issues or problems regarding that. So MPW has already cut its dividend in the past and may, in fact, cut the dividend again in the future. I don't view that as necessarily the sticking point that we want to stick to or talk about too much, but it's just good to know that they have had to cut the dividend for, I think, responsibility, taking a step of precaution to make sure that they can shore up the balance sheet, pay off some debts. Let's talk about the concerns. I think Bacon here, he's covered this alongside Andrew. Walk me through what you guys found as some of the concerns.
Go ahead, Bacon. I believe in you. Bacon, you're muted.
I said I don't, and me being muted proves that. So, it was nice to cover, a company that reported negative revenue. Go check that out on about applicable quarterly. That's funny. So, yeah. Anyways, so generally speaking, from an accounting perspective, you would want to list some sort of like allowance for doubtful accounts, which would filter into bad debts or bad debt expense eventually. But the reason why MPW and the auditors decided to go with or their accountants decided to go with a negative top line instead of like just letting their margins die is to try and in theory send a message of, oh, we're still gonna get this money, don't you worry, it's gonna happen. But yeah, I don't know. Like to me, the whole thing just seems not appealing. Like because they've sent loans to their biggest customer for sure. I just don't see a point.
Well, I'm just gonna do a slight, I guess, technical correction on that, but then I can get into the actual concerns I would have on this company moving forward. Just because I know an MPW pool is going to say, no, Bacon, that's not true. They're writing off all of their revenue from Stewart by doing what they did. What happened was, I think this is what Bacon meant, but I just want to clarify, is that what this company basically did was tell you, no, we're going to get the money, no, we're going to get the money, because they weren't writing it all off. When you got to the point that where they were at last quarter, they could either do one of two things: was say, we're going to change the accounting standard for this, which kind of is an easier argument, where maybe you can try to make an argument to make yourself look better, or you can just say, yeah, we're just writing it all off, which just looks terrible. So they chose the first option. So, I mean, it's two sides of the same coin, but it's a way that management can maybe spin it to try to make it look better. But on a go-forward basis, I don't know why you'd want to be in a company where the bull thesis is hinging on a company that has a ton of revenue due to them, is going through bankruptcy court, and you're just hoping someone buys them out, basically.
Yes.
And I'm going to present to you guys. Here's a pitch to buy my company. We just went bankrupt because no one would pay us. You want to buy us?
Basically, yeah.
Take my money.
United Health was like, no.
I mean, because people were saying in the MPW bulls will say, well, the thing was rent wasn't the problem. Yeah, the problem was that no one would pay them. So like if rent was the problem, you can maybe work with that. Like I can't work with people don't pay me. And like, to be fair, that's not probably a Steward Health issue. That's like a medical system issue. I mean, from talking to people that I know that work in the medical industry, receivables and all that's really very commonly difficult to get, especially in the US, where I don't think it hits your credit score. But let's say the other thing too is this company's going through bankruptcy, and that process can take a while, especially depending on. So if they don't get bought out during this bankruptcy, I don't know what happens to this company, because then what you're going to have to do is to start. They're going to have to sell assets. I don't know how. Like they might not sell the entire company. They might have to start selling off particular assets to pay their debts. And as they start to do that, your rent goes away. And so here, the thing is, oh, and lastly, I don't think the upside's there. Like, I feel like the idea is it, yeah, there's like this risk, but if they get through it, it's going to go back to where it was before this all happened, which was like 20 something dollars a share. I don't think that happens. I think this company, we've already seen them having to sell off assets to get cash because they're cash flow negative, or funds from operations, but cash flow negative. And if a business has to sell assets because they're losing money, that will, by definition, make the company worth less in the future. And I don't know where this company ends up in the future. The other thing, one last thing I want to say, people were pointing to the fact that they sold the hospitals for a lot more than they were worth book value wise. I have experience dealing with companies that went through bankruptcy. You don't sell your shitty assets first. You sell your best assets first because those are the ones that you can get people to buy quickly. So you probably just sold some of your best assets. And now you don't have them anymore. And as an investor moving forward, what's my cash flow going to look like? I don't know. So there's my summary.
Yeah. So it's really like it's more of a question as to who buys the assets, what price they're going to buy the assets. I saw B of A's estimate on the NAV, and the key use of the word NAV instead of book value is more important, especially for real estate. The issue is, like, for most real estate or REITs right now, they're trading at a discount to NAV or estimated NAV, right? Because that's all you can really get. It's an estimate at the end of the day. And then typically the NAV is higher more often than not than the book value. But what's funny is B of A's estimate on the NAV here is actually just at $4.30, which is fairly close to where it's at now, which would imply a slight discount to NAV. Now, I kind of went in and tweaked out some of the cap rates on NOI, or that we would kind of cross-reference with NOI, and I got a high-end cap rate of roughly, or sorry, not high-end cap rate, of a high-end NAV of roughly about $5.40. And so if you kind of take that with what you will, that would also still not imply that much upside. You may assume there's like a premium to NAV of sorts, but I don't really see the
yeah. And I'll let Jesse talk. I just want to say real quick, there's a possibility this could work out, but like I don't think the risk reward is there. Like as an investor, I think there's a lot of other opportunities you can look at. And if you're long, you should take the low end of the cap rate, Jake. Jake's saying I personally take the low end of the cap rate. If you're someone that's going long in this, your analysis should be based on that, because you should be like, with the amount of risk you're taking with this company, like everything at the bottom low end better be so attractive that it's like, okay, we're buying. But I don't know if you had thoughts. Oh, go ahead.
No, it's just like you may be taking on more risk than you might think, because if you're using book value as like your baseline value, and then you're investing based off that, and the book value is over 10 and you're buying it at $4.19 on the surface, it looks like you have a huge margin of safety, but maybe you don't. And so when I was talking to some bulls, I remain unnamed, they didn't have, I'll respect it. Like, you have your own calculation for NAV and it's different from mine. It's different from anyone else's. And you just have a calculation for NAV, but don't just take book value. Try to do your own calculation, see what you come up with. You may be right or wrong. That's irrespective of the conversation we're having now. It may be just like a really overstated NAV, but you have to come to terms with that. So looking at the NAV estimates, I think is like the first step an investor should take if they're curious or wanting to invest in MPW. But then if they stop there, I think that's still not the full process that you should be going through. But that's just like at least step one. And I found that a lot of people don't have that first step. And I was very concerned by that. So.
Yeah. I think some of those NAVs are even generous. Like, because when I look at them, I'm like, okay, what's like liquidation value, like heavy liquidation value? Because if they get in the spot, I mean, they're kind of like they're levered really, really, really high. Like even looking at them, say like 2, 3, 4 years ago, they operated at like really, really, really high debt leverage. Like interest rates going up was probably, I mean, hindsight being 2020, I bet you as soon as interest rates started going up, this thing just crashed. Like in 2022, started 2022, it probably just, yep, it totally went from like 22 to like 5 or what 3. But no, even if you look at their leverage metrics for REIT, it's absolutely disgusting. So I don't know. I would put them in the sense of, if I was like calculating NAV, I'd be calculating off of like a really big discount of liquidation value, because they're not going to be able to demand, they're not going to be in a position of power to be able to demand a decent price for the properties.
Yeah, it's something that I think maybe people aren't taking enough of a margin of safety. Do you have a price that, just spitballing, just for fun, what price do you think is an appropriate margin of safety? Because Andrew said it correctly in that it may not be like a 0, but it may just be at a permanent lower base, and then maybe in the future they could recover from there. But at a lower base, it may not be the clear shot to 10 as people might think.
When it got down to $3 the first time, I was like, okay, that's kind of interesting. But then you had some fundamental changes too, and then it was like, okay, well, their customer base is going to be like totally hosed, and the quality of their renter is really, really, really bad. So I don't know. I think when I looked at this the first time, it was like between $2 or $3.
Okay. Bacon, Andrew, again, just for fun, do you have a number, a figure?
Did I buy this at?
Yeah. No, not that you buy it at, because you may say even at that price, it's still like I'll pass
even at 2 or 3.
But
let me clarify that.
You think it's an okay margin of safety?
Yeah.
It's hard because my initial look was like, I went through it for probably 30, 40 minutes and just said like, it seems really dangerous. I don't know what. Maybe at like, I would say maybe at $1 to $2, but my feeling is once it gets to $1 to $2 means it's going BK.
Yeah.
So, but assuming the fundamentals of the business stay the same, somewhere in there. But even there, I don't know if I'd ever touch this how it is currently. It's just not really like my style. To like look at businesses that are like really fundamentally struggling and telling myself, oh, like they just won't go BK. It's not.
Question for all of it: do you guys would you guys classify this into the cigar butt investing realm?
I'd almost say worse.
Worse?
I would say junk cigar butt.
I don't know, because how junk is this?
So the bonds are trading YTM 14%. So they're well in junk. Were you asking about the debt, or were you asking about the junk as in the actual comments?
To me, this almost feels like, is the actual operating company junk? It doesn't feel like, I don't know. It feels like a special situation more than a cigar butt, but maybe I'm wrong.
Yeah, that could be the case. I mean, right now the catalysts that longs have to look forward to is on July 11th we get the first reading of the bankruptcy hearing, because right now they're undergoing auctions for the Stewart assets, and the bullish take is that they'll potentially get some amount that could cover their debts, and their debts being the rent that was unpaid. And you guys covered the negative revenue, or the negative line item for rent that was basically just removing it from the accrual basis of accounting for this tenant and moving it to cash basis,
Right.
Because they're not going to collect the rent. And there's two entities. There's Stewart and one more, but that's much smaller. But Stewart was the big one. So there's two. But Stewart's the one that actually hurts. The other ones, I think, is like 5% of rent. This one's like 20 something.
Yeah. And also, so I don't know what it is. I'm not like also one of those crazy short sellers who's out there like doing the It's Always Sunny in Philadelphia, like this guy is moving money to a Swiss bank account thing. I think take all of that and just discard it and just look at the company and say, like, do you really like, because it almost makes, in my opinion, the short argument or like the bear case against this weaker because there's so much like junk in there that you can just throw out. But if you're like long this, just look at it and be like, look at the risks. And I think the risks are, what if bankruptcy court takes longer than you think? And what if no one wants to buy Steward? What happens? And is your upside enough to... And also, I guess maybe it is a junk company because like if your company can't survive one tenant going bankrupt, that's pretty rough. Like, so...
It's a, yeah.
Well,
Weren't
they also like providing loans to their tenants and then like some really sketch stuff like that?
I think it was just Steward so that Steward could like survive during the bankruptcy filings.
I thought they were doing that with like multiple.
Were they? I was only aware of Steward, but
I don't know. Maybe it was only one.
No, there's a second one going bankrupt. So there's two
I don't know.
tenants. The biggest one is Stewart.
yeah.
And I wouldn't view it as like a dividend. It's
like why
not an
bother?
easy long. Yeah. There's
Why
so many
bother?
opportunities right now.
Like, why look for the piece of crap thing that might eventually turn around when there's so much better stuff out there?
Yeah. I mean, speaking of which, we are going to talk about some of them, and let's kind of move on to the next topic. I think because I think we've beaten the dead horse here. MPW. None of you are short.
No.
None of you are long.
No,
Nope.
I'm not.
You just view it as a why bother.
I'm just
Correct.
eating popcorn, watching it.
All right. So the next topic of today: why are you underperforming this year? So this is not directed at probably the capital mindset audience, but maybe some of you. I don't know. Only you guys know the answer to that. So. Really kind of delving deep into this topic, we see a lot of retail investors, both on YouTube, Twitter, they have like their selective champions, etc. And what are some of the tendencies we observe from them? What kind of similarities are they sharing? Everyone knows the common saying, like, be fearful when others are greedy, be greedy when others are fearful. But I think they kind of forget what that was supposed to imply or mean. They forget the true meaning of it. And so when they look to the right, they look to their left, and they say, for example, a company like PayPal, they're like, wow, the guy to my left is long PayPal. The guy to my right is long PayPal. I'm long PayPal. This is clearly we're greedy because it's we're supposed to be greedy because it's down, but everyone I know is long PayPal.
Well, do you think that's the under? Well, so are you saying people are seeing stock go down, so I buy?
Yes.
And that's causing them to underperform?
Yes. Well, and we're not going to talk about specifically PayPal because I think that's the punching bag we always go to, but any of these other retail stocks, except for a few. There's a handful that have done really well, but exactly that. They see price go down, therefore it must be value, therefore it must be a buy.
I have a counter opinion of why people are underperforming. Like not counter, but like additional. So it's and this was more probably directed at like FinTwit type people, or just it's stubbornness, because like people have a mindset of like, oh, this is what a value stock is, or I'm not going to buy these tech companies are overvalued. Well, if you haven't done that because you're just stubborn and you don't want to buy these because historically to you they've felt overvalued always, and you're underperforming, you are refusing to be flexible or review your own thought process. Like the perfect description was I read on, I think it was Twitter, someone saying all these guys underperforming can perfectly articulate the way the market works right now, but refuse to actually participate in it. And I thought that was like perfect, because it's like they're all like talking like, oh, nothing runs on fundamentals. It's like the tech goes up and it does it because of this, that, and the other. And you're like, well, then why don't you buy it? And so I think it's like stubbornness. It's like saying this is I'm only doing on this like very rigid. This is how I invest. And that refusal to be flexible has caused a lot of people to underperform, I think.
Yeah, I mean, there's a lot of people that have some sort of like, I don't know. You might see it with some people who talk on either Twitter or YouTube. They get like a rage to them about these stocks going up, and they're like, "Oh, harumph! Like, how can it keep going up?" I feel that way with Costco, by the way. But that's neither here or there. There's a deep-seated rage I have for that stock. Just keep going up. No, but they look at Strongman says it as a joke, but it's true how some of these people feel. They're like, large cap tech, bro. They say it more from rage. And it's like, okay, that has been what's been working out. It's a form of coping and seething. If you think about it, if you're mad about it, cope and seethe harder. You know, it'll help you a little bit.
Right. Do you think a lot of retail is just like stuck in maybe what I would define as the early stages of the Buffett mindset? Like Warren Buffett in maybe the first one or two phases of his investing career, where it was more like cheap value reversion plays rather than buying quality at a decent price or at an okay price and just being okay with it.
I really think investing right now is the bell curve. You have like the idiots on the left who are like, I just buy tech because they don't know. And then you have the guys in the middle who are like, oh no, you need to buy like undervalued assets. Tech is overbought. It's the entire index. I need to provide alpha, so I'm buying like this shitco at 3 times earnings.
Yeah,
and then they end up actually
go wrong, right?
And then interest rates go up, and it materially affects the business. And on the right side, you have buy the best companies in the world that are insulated from any economic environment, and then find other like plays within the market. So it's like kind of almost a bell curve.
Yeah.
But the other retail, and they're probably doing pretty good right now, that are large cap tech, or just tech in general. It's not just large cap. They did awful in 2022 because they don't really know what they're doing. They're just like, I buy these tech companies, and it's like, oh no, tech company go down. Well, I'm going to keep buying because it went down 5%, and it drops down 40%. And you just like incinerated returns for a while.
Yeah.
And so, I think those are the contributors to underperformance. One is not knowing what you buy. The other one's being stubborn.
Ooh, are we okay? Kind of going off of that for you guys. Are you kind of out of the? Has the big cap tech accumulation opportunity passed us?
No. I bought Meta like 2 months ago.
Okay.
Like I initiated a position in Meta. So once again, I was flexible and I said, I'm underallocated large cap tech. I looked at
Pump my bags.
And I was like, what? I looked at the large cap tech and I was like, out of these ones, basically I told myself like, I need to be allocated X amount to large cap tech.
Okay.
Because in my opinion, they are the best businesses in the world, and the amount that they make at the S&P 500, if the market goes up, it's going to be because of these companies. And so I looked at it and I was like, Meta looks like the best buy. And I can actually tell you when I bought it. Because it was funny. I think I wanted to buy it on that first drop when it went to 420, but I couldn't. Yeah. I think I was on vacation or something. But my first buy was on April 30th. So April 30th, 433 a share.
Thanks, Alaka.
So I bought it at 433 and no, it's done well. So I don't, and if you look at most of these companies on like a forward metric, I don't think they're really expensive. Well, maybe some of them are. I don't know, but like Meta was cheap at that point. I thought.
Yeah.
I think it would depend though on the large cap tech though. Like some might do better, or some have a better setup than others.
Yeah.
Some may have more
Oh.
vulnerabilities than others. But that's just what my opinion from a distance. Not my
So-
forte.
What makes you okay? So do you have which ones are your favorites? Like which one do you think is better positioned than the others? Completely fun question. No pressure.
Oh man, I'll defer to everybody else.
Because Andrew, I like what you said. You said that you viewed Meta as actually being relatively cheap to the rest. I thought the same. I added to Meta on that drop when they had their earnings, and that was it. I didn't really add after that at all. I did have puts that I sold, as you guys recall. I had those puts that I sold at the 350 strike, and those I recovered them. They basically lost all their value. And then I did end up buying significantly more Amazon, but I thought Amazon was also misunderstood in terms of valuation. Now we're hitting almost $200 a share. The one that I don't quite understand the valuation, I think so much has to go right, is Microsoft. And you have Apple. I mean, but I appreciate Apple for what it is. I mean, like, look at this thing. 40 times multiple. You could get Google, Meta at the time for like a 20 forward multiple, and then Amazon, if you actually looked at the cash flows, backed out growth capex, it also was trading at a similar valuation.
By the way, do you know a company, and I didn't realize they're even this big, completely slept on company, large cap tech? No one talks about this company ever.
Don't say Intel.
No, I'm not on large cap, like mega cap.
Oh
tech.
well, okay, mega.
Salesforce, ServiceNow. How big tech are we talking? Just tell me market cap, and I'll go to that.
Mega cap.
Like
Are
trillion.
you saying fintech?
It's bigger than all the companies you just named.
Fintech?
Nvidia.
No. I just said it's bigger than Salesforce. It's bigger than, what were the other ones you named?
Well, we already said Alphabet, so it's not the
Oh
Mag
no,
7.
it's no.
Under the Mag.
Wait,
Wait,
under
no,
Mag
no,
7?
no. This game is fun. This game's fun.
Broadcom.
Yeah.
Oh, okay.
Oh, okay.
But to answer your question about the most undervalued, or like ones that are being slept on right now, large cap tech. Do you go Visa?
No, Visa's not slept on. It's not.
You don't think it's?
I don't think it's slept on. I think forward returns may exceed the market, but there are plenty of scenarios where it may not. It's not slept on. What I mean by slept on is like very likely, like very, very likely to exceed with a good margin of safety.
Okay, so you're asking like slept on, meaning which one do I think will perform best in the future on the forward basis?
I think one that was recently hated that is going on a crazy run, and so might be slept on is Google.
Dude, their management. I don't know.
I know everybody hates their management, man, but I'm just saying, like I think their cloud offerings, they're starting to get more and more and more penetration.
So this is why I never sold out of Google, like fully.
Yeah,
they are I think potentially the best assets, some of the best assets in the world, run by idiots. And it's like, if you just get some competency in there. Yeah. So
I think I would probably
what do you think,
buy.
Fabio?
Let's see.
Okay.
With Alphabet?
No.
Yeah.
Jesse, finish your thought. Sorry.
Yeah, finish, Jesse.
I was gonna say I think I would buy Meta over Google right now, though.
Way better management. Yeah.
CEO surfs.
Yeah, the CEO.
Dude, I mean, come on.
The capital allocators are
flag.
just better. Yeah. But
This is the thing. I'm looking at this and thinking Amazon still looks attractive.
I was gonna say I think Amazon's still cheaper than Google.
I think, oh, I don't know. I think Google could have accelerated growth on a percentage basis comparative to Amazon on the cloud space, hyperscale space.
See,
And I think that gap could start closing.
this is a comment that we had this discussion in the last live stream, and we were just talking about how there's people who are upset about the performance of large cap tech. Yes, they may be a majority of the index, but it's not. Well, not all of them may have deserved their valuation. That's maybe the debate that we can have, but some of them have not reached their peak whatsoever. And then other parts, like there's Paul from Everything Money making the argument you should be buying the equal weight index, which is frankly stupid. So now, yeah, sure, you equal weight great companies next to shitty companies.
Yeah.
Smart idea over a very long
Basically,
period of time.
cut your winners. Constantly cut your winners.
Smart idea.
Give it to the crap.
Yeah, smart idea. Definitely going to work out. Yeah, Andrew.
So I don't know if Warren Buffett is saying, if he's actually saying like you shouldn't buy large cap tech, or if he's saying you should buy large cap tech.
No, we had this
I don't know
discussion
this-
last live stream. There was more of a aura of, or I again, correct me if I'm wrong, Warren Buffett, that you're making the argument that you shouldn't over allocate to large cap tech on the basis that it's already a large portion of the index. I would argue that you might have the right kind of argument if someone is already heavily indexed, but
That's what I was
someone
gonna
who's
ask.
not, would make sense to take some. Cut your flowers, water the weeds. Absolutely the opposite. But yes, that is the joke of what that implies.
I
I
think if you have expertise in the area that is adjacent or within large cap tech, and you have some type of knowledge and understanding where those businesses more and you want to over allocate to the index, then yeah, go for it.
Yeah. So
no, I was just gonna say I don't know why you would want to not include the best businesses in the world in your portfolio if you can find them at a decent price. I think, and the other thing is, especially if you're looking at tech.
Can I also say this to your point though? Well, finish your point, but I'm going to add to your point because I know where you're going to go. But
almost any tech that you're going to invest in is living off large cap tech. It's like an ancillary service to large cap tech. So if you're like, well, I'm not going to buy that. I'm going to buy like the big brain tech that's over here. And it's like, yeah, but like Zuckerberg could wake up tomorrow and be like, fuck your company. And then you're done.
And I've been investing for a while now. I'm not as ancient as some players, for sure. And some of the guests we've had on Capital Mindset, they've been investing for, 40 years plus. But I think if you're newer to investing, let me just tell you this, you can just on a trust me bro basis, but back in like 2016, 2015, 2017, 2018, 2019, there were people saying that Amazon was too big. I haven't heard Meta. Meta was not really said too much, but Amazon was very popular to say it was too big. Microsoft, no, there wasn't. But Alphabet, on occasion, there was actually quite a bit of chatter that it was too big, too much of the index. Apple, oh gosh, Apple. People were constantly just like dismissing Apple. It was a very common statement around some of these names that their growth, they just don't see how they grow into this valuation, and they just kept on going. The Amazon one I can kind of dismiss a little bit or give it a little bit of leeway because Amazon's a little bit harder to understand. If you have no knowledge base of accounting and you have no knowledge base of like what they're actually doing with growth capex, maintenance capex, and able to break that apart, of course it's going to look very confusing. And so I somewhat excuse the people who said Amazon just can't produce cash flow. And by the way, people with strong financial backgrounds, and I say finance instead of accounting, but strong financial backgrounds, were saying that in 2022. They were clearly wrong, by the way. But I will accept it that it was it was not that easy to see it, and it hasn't been ever that easy to see it. So, but some of these other ones that have also been argued to be getting a little bit too big, richer the skis. It's been an argument that's been used for a very, very long time. So it's just that, like I said in the last stream, not to kind of get into it, but we've talked about this also privately in the club. You know, it's about people lacking the imagination as to what the projections are actually going to hit. And that's really all it is like, can you hit those projections and can you model that out as accurately as possible? Do you have the imagination, the understanding of the business to accurately measure that out? So
I don't want to be like a large cap tech stream from here.
we're not.
Like,
And that's the
no.
Yeah.
I'm just saying, like, I don't want this stream to be just that. But I do want to say, because I hear a lot of complaints like, well, these 7 or 8 or 10 companies make up too much of the index. But you look at them and it's like, if you go company by company, yeah, you might say Apple is like a little expensive. You could say Microsoft's a little expensive. I would say Meta, Google, Amazon, you know, and these are just my opinions. I mean, there are some people that would say Apple is definitely not too expensive. There's some and some people would say Microsoft isn't either. But the common thing I hear from people is Apple and Microsoft are overvalued. Nvidia is just in a super cycle going to blow up. But like when I look at them as a whole, I'm like, no, for the most part, these cash flows are going to continue to grow. And I don't see like companies coming up and replacing them. Yeah. So if I'm just holding an index, I'm like, well, yeah, I mean, like, do you really want to have more of, hold on, let me pull up the S&P 500 and I'm just going to take like the middle company in the S&P 500. So like number 250 is DuPont DeMoore.
DD?
DD. Yeah. And then right above them is Kroger. Would you rather have more Kroger and DD and Discover Financial? Or would you rather have more Amazon, Google, Microsoft? But me personally, I'm going with the Amazon, Google, Microsoft. Now, 241, I might have a different opinion. That's Monster. So
we're going to talk about Monster. I have that segmented away.
I do want to circle back though to the whole why are you underperforming this year? Some of it also is that you could actually still be good and underperformance just happens.
Yeah, it happens.
Yeah, like I mean, you kind of would anticipate at least moments of periodicity of underperformance.
I underperformed 2021.
Yeah, like here's one that hits the home. People I imagine are aware that I have a large position in Crocs because it grew into that. At the same time, what did I do? I now have a protective put position to that will either be a drag or undercut my losses, unrealized losses. We'll see what happens because Q2 tends to be bad for Crocs. At least recent history shows. People I know that respect have either trimmed or are looking to exit. Like this sort of thing happens, and you know, if we wanted to year to date bro this, like Crocs or a company like Abercrombie and Fitch, they've quietly outperformed or have done their own respective things relative to S&P or QQQ from a year-to-date perspective. So, like, it's, you know, like, underperformance, you know, like, Crocs could have easily been something else. I mean, granted, you know, stories and setup is different, but yeah. Viewers can clip this. I bought insurance. We can all point and laugh at me.
I get the. Yeah, at one point it was up 80, somewhere around there, close to like 70 something.
Yeah.
Well, Ryan, the reason why Starbucks has underperformed is because Paul bought it, and that guy doesn't miss. I told you that.
Also,
What do you
Becky
sell?
doesn't like their energy drink.
You don't like their energy drink? You tried it?
Becky doesn't.
Becky doesn't. But did you try the strawberry one?
I didn't. Should I go?
That's the one that everyone likes. The other two, everyone hates them. I didn't see a single review saying that one was good. The strawberry one was good. And did Becky complain about the size?
Yes.
That was consistent. All the Beckys that I saw try it, they were like, the size, it's too big. They wanted it to be smaller. Smaller can, smaller cup.
We need to do
Can't you just
too much drink.
Show.
Can you just like drink less? Do you like have to drink it all? Is it like it's in front of me, I must drink it?
Yes.
We'll talk about Builder. We'll talk about Builder. But I see you asking again and again and again. Don't worry. We'll talk about Builder. But if you're
Boba the
underperforming
dog.
because of Builder, I mean, it is a cyclical business.
To be fair, Boba the dog is like very much role playing their name because they're like Builder. It's like a dog, you know, when they get obsessed with like a ball.
While sipping on boba tea.
Yeah. But Ryan,
You complain about my size too.
Very nice ET.
see, that's
home.
funny. If the P ain't 3, it ain't for me. Okay, Paul. I know you're joking, Dividend Dude, but and Dividend Dude, I saw that you're buying Nike. I don't know Nike, but Nike seems like it's justifiably selling off. I mean, we talked about it in the last stream. But yeah, the Ryan, you got to hold strong for Starbucks. Hold through the Paul punishment. It's going to perform for quite some time. He's got to sell out of it or sell covered calls against it, called away, and then it will rocket up right after. But so I sold at 95. What'd you sell at 95? Oh yeah, you sold Nike. I know that, Ryan. You sold Nike. But on that discussion on underperforming, I think we can move on to commercial real estate and our thoughts on commercial real estate. So I think on this panel, actually 3 of us own Kilroy, and that would be myself, Jesse, and Andrew. I don't think Bacon owns Kilroy. And so that's the commercial RE exposure that I have. Oh, no, that's right. I also have Alexandria. Alexandria is actually larger than Kilroy, but the yeah, that covers it because the other one is not. The other REIT I have is not.
Shout out Joey
Commercial.
Agree.
Joey Agree. I mean, well, I did have the preferreds until just recently, but yeah, Joey Agree Realty is a fine REIT. So, what do you guys think about commercial real estate? Do you think we're going to hit a bottom here soon? And depending on what asset class we're really talking about, or property.
I feel like it's that. I feel like that's that meme of the kid with the stick, like at the ground, like hurry up and do something. Just like, come on, like.
Oh, the poking
Do something.
one.
Yeah, the poking stick. I'm like, come on.
Green candle just bursts up out of nowhere.
So I have another play that I have on commercial real estate that's larger than KRC for me, but we can talk about that potentially. I think on a fundamental, actual button to seat commercial real estate, we've already bottomed, or we're in the bottoming process. I don't think stocks have reacted to that yet. Just based on like, well, in particular KRC, based on like the San Francisco traffic data that I've seen, it seems like there's traffic has been consistently picking up, and it seems like it's bottomed. I mean, maybe people are like, usually that's a fairly good indicator for that. And at the current prices that we're at, these guys feel really undervalued, like a KRC. And you have to remember too, REITs are very sensitive to rates. That even goes to like the office real estate play that I have that's not even a REIT, but they still react to rates very much the way a REIT does. Just because they're in that space. So you also have to think like you might be hitting a sweet spot of, in my opinion, office real estate fundamentally has recovered and rates are going to drop.
I'm just putting that first so you can set the record, but continue.
No, that's it. Like you might hit a sweet spot of rates dropping, which is going to make your rates go up. If you're someone investing in REITs and rates affect prices of REITs, like there's no argument to that, I don't think.
Some REIT pros out there would argue against me on that back in 2021, but
right,
rates still matter.
And they have been proven wrong.
And but my this is the person, I won't say their name. They're very big on YouTube though now for REITs specifically, and they said that to me in 2021 in their Seeking Alpha comment section, and shame. Anyways,
but I think it's been proven though that you're right, that rates do affect. Then, in that case, rates do affect the price of REITs. And so, if you get to a spot where rates are dropping and office activity is picking up, you're going to be hitting a very nice spot with some of these REITs.
Yeah.
So,
like KRC, for example, is really tracking treasury yields. Like it's
Like
really
heavily.
yeah.
Like
So
but also think like what also tracked treasury yields in rate hikes was layoffs in tech.
for KRC, yeah, layoffs in tech has
So it kind of makes sense that it's tracked in some sense because like the companies that got hit first by those layoffs because of rate hikes was tech.
McBudity. Rates affect the price of REITs, but not the value of REITs, which is zero. Yeah. Okay. So great question, because this is on the topic of commercial real estate. So realty income, I think, has some structural issues ahead of it. And it's not that it's a zero or anything like that. It's just that it's going to have a struggle to grow. Due to its size, it has to take on an ever increasing number of real estate properties in order to make or move the needle. Let's just keep it like that. And you can see that realty income has begun to diversify into property types it used to not have much experience into. Typically, the market does not assign a higher multiple for extra diversification across different property types. It actually applies a discount because it implies lack of specialty. Lack of specialty implies lack of expertise or lack of being the top player in that. So as an investor, you can think of the market participants. They say, I could invest in O that does all of this, or I could invest in the best of each one. Right? Not everyone's like a JP Morgan, where in their sector, they are the best at every kind of banking, right? So it's not every sector can be defined as that, where we have one player that is literally the best at every kind of thing that sector could possibly do. So in the case of realty income, as they begin to diversify the real estate portfolio, they're doing casinos. And what's the best casino player? Probably Vici. So then the question is, if you're an investor, do you want to buy the best triple net and then the best casino player, or do you just want to buy O? Do you want to buy the best industrial player, or do you just want to buy O, right? Do you want to mix and match best of breed REITs, or do you want to buy O that does everything? The same question was actually brought about with WP Carey. WP Carey is trying to divest their real estate in an effort to undiversify their portfolio so that they could focus in on industrial properties and then get a higher multiple. Because for REITs, some higher multiple does actually matter. It matters when it comes to calculating the cost of capital. And at the end of the day, a REIT is just trying to generate a spread. Now, they basically have to, getting into like the VNQ question I saw Fake Alias already responded to the gist of it. Market cap weighted indexes are fine for traditional businesses that can scale into infinity, and you don't limit yourself to a single sector. Market cap weighted for depending on the sector, especially in businesses that have like a scale cap, like real estate, I view as problematic, because as they get past a certain size, it becomes harder and harder and harder for them to continue to grow. Realty income is facing that, and you're seeing that by their behavior. There's others like Agree Realty that people are freaking out about in a good way. They're saying yes. It's at the right size where they're still able to acquire properties and move the needle and not really sacrifice quality. They don't have to over diversify and the like. So that's my gist on realty income.
So realty income's like the biggest player, right? Most diversified, biggest player essentially in REITs.
Not the biggest,
Most diversified.
but they're the most diversified, largest triple net REIT.
Okay.
So like Prologis is larger than them by market cap, for example.
Go
Bacon?
ahead. But I do have a
No.
thing
Go
that
for
I
it.
want to circle back to in this.
Circle back.
Okay. So on rates and REITs, didn't the ECB cut rates?
Yes, I did.
June?
And Canadian,
And
I think the Canadian Central Bank
all
did
right.
as well.
So I mean, would you say that the price movement for like an Around Town or a Vonovia has responded as we would envision, or is it because the rate cut wasn't big, or because of future projections, or for whatever reason the market over there just isn't as responsive or maybe not as efficient?
No, I think it's perhaps nuanced. I think because we're making a guess about what market participants are saying. But
Hmm.
if you kind of think about it this way, I'm an investor and I'm thinking about real estate. What are some of the concerns I may or may not have? So there's, of course, cost of capital is one of those and how I can grow. But then there's also, well, refinancing is also part of that. But how about how my tenants are doing? So why might the ECB be cutting rates? Maybe my tenants are
Okay.
doing poorly.
Yeah.
Maybe my tenants are struggling. Maybe that implies lower rental growth. Maybe that also implies higher delinquency rates. There's all these questions that some market participants might be asking. Andrew.
Question, because I'm looking at realty income.
Mhm.
Is anyone not scared by the Walgreens being their biggest client?
It's like 2%,
It's
or
3.5%.
3.5% of rent. Okay. Um, I don't own it, so I'm not scared, but maybe add that more reason as to be cautious.
And then Red Lobster is another 1.1%. They're going BK.
Oh, that's also true. I forgot about that one.
AMC probably isn't long for this world. They're another 1.1%.
Yep.
I don't know if CVS is going to cut locations or not. I don't know. That's 5-6% of your base right there. That's like in question. I wouldn't say all of Walgreens is in question, but to your point, I don't know moving forward how that looks.
Paper cuts add up, is what you're saying.
Yeah. And damn, that's crazy. Just the Bellagio is more than like all of Red Lobster. But
It's a big property.
And
yeah.
the shrimp.
Yeah, there's added concerns for realty income, which I think they'll surpass, but I think those properties can be repurposed. It is a chink in their portfolio that probably doesn't do them any favors.
Mhm.
But I don't view it as like their Achilles heel right now.
Right.
It's not like EPR properties with an Achilles heel to AMC. Like that's insane. That one's gonna get cooked if something happens to AMC. Or MPW to Stewart Health,
Yeah.
So it's 3-4% concentration, not the end of the world. But then you add AMC, so you have a couple. You have at least like 6% of the portfolio that's under distress.
If you're gonna get realty income, why not Blackstone?
That's another good point, right? So playing another kind of aspect of real estate in private equity. That's a great point. That's something I also want to bring up is like there's another way to play real estate in C corps via private equity firms that can get the upside from the real estate, but then are using other people's money to get it.
I was gonna say, aren't you
And Blackstone in particular is very real estate focused.
true?
Yes.
But aren't you worried that the word is out about them volatility laundering more or less?
It's been out.
Yeah, like
No one
I
cares.
don't know. Okay, fair enough.
You're talking about like controlling the outflows and stuff like that.
Well, I mean, one part that which you would think and hope that like everyone from wealthy individuals to like pension funds and etc. like of those ilk would do a better job being aware of this, but I don't know. If it models out well, who cares, right?
No, it's in the interest of the pension. We get this. It's in the interest of
Yeah.
the pension funds and endowments to have their marks up.
Yeah.
So
they want the volatility laundering.
Yes.
Yeah.
And you saw it happen in 2022. And what happened? They got more fund inflows. So,
Always.
I'm
we'll
bullish private equity for scamming. Hell yeah. Hell yeah. Get paid.
No, they're not scamming. They're just being opaque. Okay.
They're just
Well,
not telling.
I mean, if some of the customer base wants them to be opaque, just don't be the sucker customer that doesn't know any
needs the
better.
capital and
Yeah.
tries to take it out and can't take it out
Yeah, no kidding.
and thinks that there's a value, but there isn't a value.
Yeah.
Yeah. So there's Blackstone, ladies and gentlemen. All right, commercial real estate. What about Boston properties? Any interest in Boston properties? BXP?
BXP.
It's
It's
basically
solid.
Kilroy, but
I owned
yeah.
it for a stint, and then I sold it.
Not tax advice, but it's an interesting take to have KRC. And if someone is down on KRC, which I'm not down on my cost basis, but if someone was down on KRC, you could still play office, A-class office recovery, getting rid of KRC, and then buying BXP. Speak with your own tax professional on that. Make sure.
Yeah, disclosure.
Yeah.
Disclosure.
I haven't really looked at BXP. So they own just like A-class office real estate in the Boston area.
Correct.
DC, Seattle,
yeah,
San Fran,
bunch
yeah,
of
LA.
Yeah,
Oh,
they're
so
a lot
they're-
more diversified
Yeah.
Much more
geographically.
Yeah.
But KRC has a better balance sheet.
Yep.
See, I've looked at KRC pretty extensively. I haven't looked at BXP, so I can't give an opinion.
Yeah, I consolidated a lot of my REITs just into KRC, just because
You notice
one
the
to
behavior.
track, you know. Yeah,
And also, I think it's a really good IR play. IR has come down. KRC is going to go up.
yep.
But
So, and Andrew, like exactly what you said. If not only do we get interest rates going down, but then the market realizes that there's going to be actually some type of a rebound and growth assumption in Kilroy's markets, then we're re-rating on multiple fronts, and that could get very, very fun.
Mm-hmm.
So
exactly.
And until then, I'll collect my dividend, guys.
And you're still outperforming Paycom.
It's true.
That's my benchmark, by the way. That's my
Paycom is your benchmark,
Benchmark.
dude.
That and Fortinet.
Man. Hey, Fortinet, I'm up on Fortinet. What are you talking about?
Yeah.
are these shots being fired and I'm not aware of this?
Yeah.
Or is this
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 not
might
Jesse
not be
though.
at me.
It sounds like it's at Jesse, but it's not.
It sounds like it's at me, but it's not.
Okay.
Like, dude.
Oh.
Yeah, we're going.
yeah.
Oh. Okay.
This is like if you bought Paycom, you know,
what is
like,
going
at
on?
like
I was like, bro,
$400 a share.
Yeah, I was like, Andrew,
Damn.
that is it. You are
Analyst
time
fight.
out.
Oh no.
No. It's a different. No, I'm taking shots at someone. I think I bought it like 400 or 350 a share.
Yeah, no, they said 350 where they're like, oh, this is the bottom. Like it's bouncing back here. This is the bottom. On
Why they
right
think that?
at
Oh, I see.
300 when it started going up right there, they're like, oh, bottom's in. Boom.
Oof.
No, not really. Although on the Fortinet topic, yes, I bought it way lower than where he was talking about it, but I missed my Fortinet Palo Alto rebalance opportunity. There was a moment, and I was being greedy. I think Fortinet was at like 70 and Palo Alto was like 270 or so, 280. I was looking for the opportunity to swap and just move all Fortinet into Palo Alto, and chickened out. I did not time it right.
CrowdStrike will always be there for you.
Yeah, I will not be there for CrowdStrike though.
Oh, that's sad.
It is.
It's weird because no, I'm not. I'm joking.
Yeah,
No, I want CrowdStrike so bad, man.
I should have bought so much more.
But yeah. BXP,
Yep.
interestingly enough, no properties with a harbor.
Boston Harbor.
Boston Harbor.
So I'll say for Paycom though, I'll disclose I have a put position. Sold.
Yeah. A bearish. Bullish.
Bullish. It's a bullish.
Expression. Yeah.
Yeah, expression.
Bearish put or no bullish sold. put.
Dude, the victory lap. By the way, so I
You are itching.
there is a victory lap that is coming, but I'm the one who's
Oh.
being the stick. I'll take full blame. I'm the
And
one being the stickler,
it
not
is
allowing Andrew
coming.
to have his victory lap. But just a fair warning. There's one, and I'm basically holding and gagging Andrew, not letting him be free on this. But because I can see it in his face, he really wants to talk about it. We're
Yeah.
almost there.
We're almost there.
1 to 2 weeks, and that guaranteed victory lap will happen.
I do want to say these HCMs, I have both of them on my watch list, Baycom and Paylocity. And I'm just like sitting here like at some point
Yeah.
they'll bottom. But then I'm like
Same
also
here.
like the business kind of sucks compared to like other business, like the operating leverage and the like profitability is nice, but I feel like there's a bit of a lack of a moat. Like it's
Is it really that low of a moat for a larger enterprise? Isn't it a pain in the butt to switch off? Like, why does ADP have the multiple it has, right? Because it has a huge moat. Try to take ADP's customers away. That's why I'm like, is it really that bad, Andrew?
I didn't have a hard
I don't know.
switching off
I don't
wasn't
know
that
if
bad for me.
No,
don't
but
know.
I'm saying like
Like a large
big-
enterprise.
Yes. Those
Yeah,
guys.
but isn't that like a mark against Paycom because that's the target like demographic they're trying to go after now?
But if they get one,
Sure.
I mean, if they got a large company, like if they actually started making headway in, like into that area, like
short ADP, long Paycom.
shit.
Because
But
I'll just go ahead. Sorry.
no, you go.
I was gonna say
No,
the difference
no,
between
you go ahead.
switching like an HCM versus like an ERP is massive.
Look at what this man is saying. I gotta move temporarily. Look at what this man is saying.
Man,
Andrew,
I wish someone would have told us about this.
it's like last year. So I wish someone would have said this last year. So dividend, dude, that is an actual issue. Andrew's talked about this extensively in prior streams, and from his work experience, which I don't know if you want to get into it, I'll let you take the floor and then just
Sure.
summarize.
And
it.
I for my company, I'm the CFO, so I have the ultimate say on like who our HCM is. And we had Paycor, dog shit. If someone's on Paycor, run. If you're considering getting them, like run for the hills. Actually, going along one of these and shorting Paycor might be good. Oh yeah,
Air
dude.
freight. With sorts.
We should have
yeah.
shorted them when you told us this. We should have shorted it.
Yeah. And so basically when we're looking at it, I want to say Paycom was 3 to 4x the cost of Paylocity for us. ADP was in the range of Paylocity, but the problem with ADP is we're small where like their model is just you're too small of a fish to like matter to them at that point. And like then you're kind of getting like different products that don't work that great. So I that's kind of how we fell on Paylocity, which by the way I'm happy with.
Which that seems to be pretty much the same thing that anybody says on any type of technical forum that's discussing HCMs.
Right. And the other thing is like really the thing that's kind of incredible to me is like the fact that Paycor was such a bad experience. That was the more incredible thing. Like they messed up taxes for our entities. They didn't file things on time. They like made all these mistakes that I had to go and like manually fix with the IRS. And I'm like, dude, we're done. Like the more incredible thing was how bad they were. And the big thing Paycor did that made the experience so bad was they sold and then outsourced their customer service. So I used to have a person by name I could call and talk to. No, now I call in. It's like calling into like your Wells Fargo customer service line. And I'm like, and I told them, like, I remember we came to a specific issue And I said, you're paying these people a check and you're taking no taxes out of that check. And they're like, no, we're taking taxes out. That's wrong. And I was like, no, you're an idiot. Listen to me. And they're like, no, we're taking taxes out. And then they completely messed everything up. And so, anyways, Paycor is terrible.
So what's interesting though,
Mhm.
what you guys are talking about, what we've seen like kind of on various tech threads about Paycom versus Paylocity is like
Mhm.
you could speculate that Paylocity might even have a greater moat than Paycom and greater pricing power than Paycom,
Mhm.
because not only are they better from the tech side, better from the service side, customer service side,
Mhm.
but if they're really equivalent services at 25 to 30% the cost of
Right.
Paycom, they have a lot
Um,
of upside on their pricing.
Paycom has Betty is a good product. Betty is a very good product. The issue is if you basically the way Betty works is that if you don't have a lot of hourly employees, which a lot of jobs don't, or a lot of companies don't, the value of it's kind of wasted. But the
Yeah.
problem is Paycom pushed out and was like, everyone's going to use Betty. It's going to change the world. And I was like, I looked at it and I was like, that's cool, but like all my employees are salary.
That's not what I need.
Yeah. So it's like, and they're like, yeah, but it's like better. So you're going to pay us 3 times the cost. And I was like,
You're like, I need a car, I need a car, I need a car. And they're like, hey, check out this horse. And you're like, no, I need a car.
no, it's more the way I would compare it is like, it's like, hey, I need a car. And it's like, well, look at this Lamborghini. I'm like, yeah, but I just need a daily driver.
That's a good one.
Like, I want a Corolla, man. Like,
So
I just need to get a point A to point B.
yeah,
Here's
exactly.
a high-speed train.
it's like that's cool. I don't need that. But
Yeah, I can see the arguments there. And okay, so with HCMs, I guess you would say ADP has the incumbent advantage.
mhm.
Multiples assigned very high because they have all the customers that you really want, which is the guys who are never going to switch because it's just too much of a pain in the butt. And then you have the smaller players that are all fighting for the smaller fish, but Paycom, right? They're trying to go for the bigger fish. What's their, Jesse? You said the other day that their the retention rate's like 92%.
I think it was like 90 or 91.
That's fairly high. That's
Yeah. And because
No.
I think ADP is 92 retention rate, and then Paycom was like 89 or 90, and then I want to say Paylocity was like 91.
what Lakers?
Good old Alaka.
Alaka's confusing me.
Well, I mean, I think I get what he means.
Thoughts on Kava? All right, we can kind of go into the Q&A session, but I gotta handle this one first.
What a
All
monster.
right. Oh yeah, Andrew.
Okay, I don't know if
Defend
this is a
yourself.
leading question because I've seen Boba since post like 8 like monster better than everything. So I don't know if he's joking, thinking it's a dying company. I don't know what kind of I don't know who you are if you think it's a dying company. Like I don't know on what metric it's I mean like it's not growing as fast as it was before, but like it's not dying.
This will trigger you too.
Pep is great, the monster.
Well, I mean, Pep has an entire
I feel-
free-to-play monster.
I
That's
feel,
different.
I feel like it's also different because like Pepsi's like Coke, where it's like the distribution network,
Mhm.
and then you also have like because Pepsi. How big is Pepsi's international distribution network? Is it as big as Coke's?
It's
It's like
just as comparable.
Yeah, I was
Comparable.
gonna say
Hmm.
yeah, comparable at least, probably.
okay. So like
Coke
I
is
feel-
better, but Pep's is
Mhm.
good. Very good.
Yeah. What is the
Forward growth is like mid single digits. Mid to high single digits, depending where you.
That's not bad though. Mid to high single digits. I thought Pepsi would be more like mid to
No,
low single digits.
That's kind of why I was talking about it recently. I was asking around about it. I was like saying, "Hey, this looks pretty interesting. Anyone else interested in this?" But it's not going to blow your socks off return. But if someone's looking for stability, I'm not buying it. But
I'm seeing sell side saying like mid to low single digits.
I think Boba wants more than just Monster.
Okay. Oh. My returns. But yeah, my returns have been better than Monster and Pepsi. I agree. That's what you're talking about. Okay, so I'll talk about a couple of things. First one about Monster, just so we can all level set. Celsius is not really eating into Monster's market share. Sure, there's some overlap in customer base, but the actual customer of Celsius is Becky. It's primarily women. There's some men. I mean, obviously, I want to say it's either 50-50 or like 60-40 women to men.
It's majority women from the stats.
Yeah. Monster's like 80 to 85% men. And if you look at and this is going to be stereotype, although I have it on good authority, Monster will tell you this as well. They target the construction workers, the guys who put on their hard hat and just go to work every day. They're not targeting the Beckys. The actual thing, and I am still salty. Monster should have hired me as head of M&A. I should be making millions of dollars right now. But Celsius is actually really going to be struggling because Alani Nu is eating into them. And what you have as well is Starbucks is really pushing for their in-store products. They are looking at themselves and saying we need to re-push and refocus on growth. And I will ask you, Dividend Dude, who is the distributor for Starbucks and their in-store sales? Not at a Starbucks outlet, but if I went to go buy a Starbucks Frappuccino at a gas station, who is the distributor?
I'll say for him, Pepsi.
It's Pepsi. And who is it for Celsius?
Pepsi.
It's Pepsi. So what you're seeing is if Starbucks starts to get back on the shelves and really starts to now you're seeing Celsius getting crammed. Someone saying that Alani is wrecking both Celsius and Monster, sadly. I don't think that's the case.
Not at all. No.
It is definitely targeting the same audience that Celsius does.
Small cans, colorful, cute cans.
Yeah. So if you look at Monster right now, there's two parts of the Monster story that are important. One is gross margins. Gross margins have come down since because of COVID, and they've been recovering. I want to say they're at 54.5 now per the last 10Q. I think they are going to, per management, they should get back to $60 a share. The recent sell-off, there's worries about growth. I think people are looking. I mean, with Monster, I think there's always a worry about when are they going to teeter out on growth? Because they feel pretty fully penetrated in the US. I'll say that. However, they're growing mid 20% in Europe, and that'll continue to grow. Or maybe it's 15 to 20%. They're growing 20 to 25% in Central and South America. They're growing roughly the same amount in China and Southeastern Asia. And so while the US story is, just kind of pricing power and things like that, I know Q4
alcohol
and alcohol. Their alcohol is growing nicely.
It's alcohol and pricing power.
Yeah. And so I think with Monster, what you're having now is the questions around them are CEO transition. People are looking at Starbucks. They're looking at Celsius, and they're looking even at you could argue Monster's last earnings weren't amazing, and they're saying, are we over diluted in the energy market? I don't think we are. I don't think Monster has to worry about that. And I think that Monster is going to be completely fine. And then I think internationally, they're just going to continue to grow. So all they need to do, and by the way, the other thing that people don't talk about is the energy segment is growing. And so as long as Monster maintains their overall market share across all their brands within the US and they increase their pricing power a little bit, they'll have some solid, steady growth there. And then internationally is where the real growth is going to come from them. And that's why it'd be really impressive for them to get 60% gross margins per management guidance. I'm ready to buy one drink company, and now let's argue. But let me just wrap it up. So the other thing that people are worried about with Monster is basically insiders selling a bunch of shares. The way they did it was by having the company buy back the shares. My argument is it's primarily coming from the retiring CEO, and yeah, it's not a good sign. I mean, there's some signal there for sure, but I wouldn't look too far into it. The guy that he has replacing him, he's handpicked since 2021, so I wouldn't be super mega worried about it. So with the overall worry and the slowdown in energy, Monster's last earnings maybe not being the best, and then Monster blowing a huge buyback to basically give exit liquidity to their C-suite. Some people were questioning it, and it sold off to a forward 25 PE, which is basically the historical low for Monster. And I remember Fabio was also pulling up max drawdown charts for Monster, and they were hitting right at their max drawdown, and they popped off that. And so we'll see where they go from here. I think one of two things happens moving forward. The concerns are right, and maybe it sells off another 10%, and then it normalizes, or it's wrong and it pops and then continues to just outperform for the next year or two. To me, it's just been severely de-risked because there's nothing. I mean, sell side thinks that they're going to continue to perform. Everything that I've seen from them seems to indicate they will perform as well. I'm not seeing like we say, Kyle's more loyal than Becky. I don't see their core consumer switching off. And the other thing too is if you switch off of Monster, people don't realize this. Monster owns Bang. Monster owns Reign. Monster owns Full Throttle. Monster owns NOS. If you're going to switch off of Monster, you're going to buy one of their competitors. So I wouldn't.
Unless you go to Red Bull.
Yeah, unless you go to Red Bull.
And what did that Monster guy say in response to the Alani acquisition?
He said, we target the people that build America, which I'm not a huge fan of that response.
Wow, spring.
What?
Because we can't let people hear us, so we're talking in whispers. That way the people watching the live, then they can't hear us, so that we can say the secret.
Shout out YouTube closed caption viewers.
As long as we talk like this, they won't be able to tell.
Oh, okay.
I already know. That's why I did it in the first place.
Wait, is it a lie? Yeah, it's a lie.
This is horrible.
This is Stock Talk ASMR.
Dude, I'm in crippling credit card debt over this stock. But they can't find out. If the audience finds out, it's over. More. Yeah, the bank keeps calling me, but I keep hanging up.
So back to energy drinks.
Your regularly scheduled programming.
If you guys want, we can start a second channel. Be like ASMR stocks. We'll just go the whole time.
Yeah, just whispering
Just
while
fall
you're
asleep
doing
to it.
Dude, that'd actually be like, I would listen to that. It's just kind of soft, relaxing people talking about stocks that the whole time.
Gross margins of 58%.
I'd actually prefer that because most ASMR is
Bullish right now.
no, because here's most ASMR. I found a banana and the banana is yellow and it's got some brown spots on it, but it's still mostly yellow. It's mostly yellow. There's a brown spot. And you're just dude, this is the most brain dead shit.
Oh, what about that car dealership that has attractive-ish looking people?
Okay,
in, Bentley.
You laughed. There was already a channel I found back in 2020 that was already doing this.
Really?
Oh my
I'm
God.
not joking. It was stock market ASMR. It was like a guy
no.
like trading and stuff and talking ASMR. But anyways, the algorithm blessed me with that. I was like, the hell is this? This was like when that whole thing was popping off. And
It's probably
Yeah.
on like
Good
Quantum
God.
Escape.
but all right, so we are going to talk about Hershey's.
Oh, I was
I
gonna
saw
say
it.
related to Monster.
Yeah.
Like I feel like they have probably such a loyal / locked in customer base
Mhm.
that even if it dropped, like you're gonna have their core customer base. I don't think you're gonna see much churn off of that.
Yeah.
They're gonna be around for a long time.
Yeah. And let's not forget another point to Monster. What about that balance sheet, though?
Very clean, especially for stable skills that are
Money.
normally levered. Of course, it's not going to be
What
as
about-
good.
what
'cause they
about
just
that
spent $3
debt,
billion.
though? Boom.
Zero.
But
Zero
hey,
debt,
you
lots
do
of
want to
assets.
buy the company before it starts to lever up, because that's when you
Yeah.
usually get.
Growth and
Yeah, exactly. So Monster is not
Yeah, I mean,
levered at
that's-
all. So
Mhm.
I really think that new CO is going to lever it up. I know that you may not like that, but
I don't. Okay, so we can talk about this right now. I don't. Levering's not bad. If you think
no.
if Monster can get debt for 6%, I would think 6 to 7% maybe. If you don't think that Monster can generate a ROIC on their investments of 7% or more, then you shouldn't be investing in the company. So,
Very
like,
fair.
Yeah.
in some ways, I feel like that's good.
I just wonder what they would put that loan to.
Oh, Rod, I just keep giving me this anecdotal evidence. It's like,
Kyle, it's the exemplification of Kyle.
Yeah.
I'll say this: like, I sampled energy drinks, and now the one that I'll go to is, funny enough, Monster brands. Like, I'll
Yeah.
go for a Reign. I'll go for the traditional Monster. I forget not the Ultra, the Monster, the colorful purple one.
colorful. Is it the tea one?
No.
Is it
It
the
has
juice?
no. It's like a
Ultra Zero.
Ultraviolet?
yeah. It's
Yeah.
when you recommended to me, and I tried it. And I was like, this is actually like, I like coffee, so I'm a coffee drinker. I like coffee, so it's not going to replace coffee to me.
Mhm.
But if I
Yeah.
was out and about and I needed something, that's going to be my go-to.
I tried to like Celsius, just never happened. I think it's kind of disgusting.
Celsius?
But yeah,
Okay, so this is a problem with Celsius. All the physicians that I speak to, this is a problem. It is not healthy.
no.
It's not healthy.
No.
And anyone who's actually seriously healthy knows that. It's like, who are you kidding?
I've said this. The difference between Monster and Celsius is people that drink Monster know it's unhealthy. Like,
Yeah.
why would you? And like, come on. You look at that ingredients list and you're like, oh, this is very healthy. Like,
Burns fat. Burns fat. I don't know about that. Maybe
By eating your
Midge.
stomach.
I would argue that you could argue it burns fat because you're not drinking a coffee instead that's like 300 to 400 calories. That's not truly burning fat though. It just means that you're not.
But
kind of
if you're
coffee are you drinking?
if you're drinking like
Dude,
straight
who is
black
Celsius
coffee, man.
targeting?
The Frappuccino girls? What are you
Yeah.
talking about? Really? Oh shit. Well,
No, I mean, like, I would assume if
oh, you're right. It's people who don't like coffee. No, you're right. You're right. No. You're right. What am I even
Yeah.
thinking? It's people who don't like coffee.
yeah,
Of course. Yeah, that's the only reason why you drink a Celsius. If you enjoy coffee, you drink a coffee.
If you like syrup, you'll love Celsius.
Yes, exactly. Yeah. So I think that just like the whole Celsius is the one that has to be afraid of Alani. Alani is going to come after Celsius customers. I don't think the males within the Celsius brand, you'll have to worry about that because it is what it is, right? It's just like there is the marketing of Alani is targeting a specific kind of consumer, but it's a big portion of Celsius's target customer audience.
On the topic of energy drinks, I do want to shout out Surge. If you know, you know.
Surge.
Surge is old school. I actually
It is
saw
old.
Surge like maybe like a year ago, and I was like, I didn't know they still exist.
Oh yeah, yeah, yeah.
Surge?
It's got a revival. Because I think it's like kind of owned also by Coke, at least partially. But
Is it
yeah,
really?
yeah, yeah. Because we've been over this. Remember, like when I wanted to do some like competitive analysis of at least like glancing around, I'm like, oh, all these brands. Like,
Oh yeah, you're right.
yeah.
Okay. I tried Ghost and the Sour Patch Kid Ghost. I can see why some people would like it. It's too sweet for me, but
Same.
it tastes like my childhood.
No, that's the one that if you're a Monster person, you'd be most concerned by. I think.
Yep.
Is
Ghost. And that's Anheuser-Busch. You just pray that Anheuser-Busch is so bad at managing the brand that it doesn't go anywhere.
Oh, I'm wrong. Surge, yes, ownership by Coke, but Fizz, National Beverage, that one owns Rippets. Shout out to those people also, you mad lads.
Yeah, Rip It is very military focused.
Uh-oh.
No, and that's yeah.
For shame.
I tried Ghost, and I just
Bearish.
there was something about the taste I didn't like, but I know a lot of people that drink it. I don't know. That's the brand that like if you're worried about like the Monster core consumer switching, that'd be the one. You don't care about Celsius. You don't care about Alani Nu. You care about Ghost. Because you know what guys don't want? They don't want a little cute can.
I'm so dead. I can't handle that comment.
we have a group of characters here that like to entertain us in the chat, you know, and sometimes they really entertain us, and we just have to take a break. Well, Fakius, I feel like it's too early to say whether or not Ghost will take from the next generation because, like, we'll see how they manage Ghost. But,
Gotta love the internet. Gotta love YouTube.
But,
okay.
Dip button?
Sorry. Okay. Whew. Okay, back to being normal. All right, Monster. All right, Hershey's. We were asked Hershey's. I'm not gonna look at chat anymore.
We were also a Builder, weren't we?
Yeah, we are gonna talk about Builder. We're gonna talk about Hershey's. Hershey's, the individual is like, you know, we already answered a Boba the dog question.
That's true.
We'll take a turn.
Yeah.
Hershey's. Anyone here buying Hershey's?
I have to look at it. I've just been, you know me, I've been busy looking at other stuff. And I have to look at Hershey could be interesting here. My thing is I have to understand the situation with Coca and understand how much of an input cost it even is. Because is that truly like, I don't know how much an input cost it actually is for them. I would assume it's a decent bit, but I could be wrong. I know it's traded like pretty much okay. So last time it traded at this level on a forward PE basis was like 2018 during early 2018. Actually, it wasn't Taper Tantrum was the end of 2018. Interesting. It's 2018. Looks like it bounced back up quite a bit, pretty aggressively on the valuation basis off that. And before that, it was like 2014. No, 2012. So definitely like relatively low PE. No, there wasn't really. Well, maybe it had a price drawdown, but the drawdown wasn't to this level. And then there's like a blip for 2020 where it went down for a second. I like chocolate. It doesn't smell like puke, so I guess you don't like Hershey's.
Hershey's not that bad. Like I do
No.
prefer other chocolates. It's not that. It's not puke.
Well,
It's
I mean,
not
I don't know if
really-
you guys know this,
yeah.
but I don't eat candy. So like, I don't remember last time. I'll eat dark chocolate sometimes, but like, I don't really do sugar. I don't know how you guys don't like Reese's though.
What I wonder is their inventory situation a little. Because
Oh, go ahead.
go ahead. Oh, okay. I was gonna say like it seems like it's ping ponging around on a quarterly basis, but annually it's been growing, and maybe that does help because obviously you need inventory to generate any sort of cash flow in this line of work. But like you guys are aware of Hershey's manufacturing practices, yeah? Like generally speaking.
No.
Yeah,
No,
like it
no.
it just keeps cranking out, like at least from a Hershey's Kisses perspective. But like the how things are made, or like those series.
Mhm.
Like every now and again, I'll just like tune in and kind of veg out and be like, oh, that's neato. But yeah. So I don't know. But then again, there's such a established company that even if inventory is an issue, maybe it's something they've handled
Yeah,
before.
if it's growing in line with like revenue or sales, I would think that's not a big deal. Because I do kind of see like days of inventory seems to chop around a bit, but kind of stays pretty consistent.
Yeah,
Yeah.
and then again, we're talking dollar, inputs of
Yeah,
inventory.
exactly. Dollar
yeah.
inputs and your dollar input would increase as your revenue's increasing, but if your days of inventory is staying, the same,
Yeah.
then that's really what you're kind of looking at.
Mhm.
Oh, they own one bars. Interesting.
They also own a couple salty snacks. So they own like
Mhm.
Dots Pretzels, Pirates Booty. Pirates Booty is pretty good.
Pirates booty.
Dude,
Yeah.
that's base. I want to
I'm-
buy some.
I'm going in.
He's gonna eat it on the food deck.
Pirates Booty is one of
Buy
the,
some
probably the
Hershey.
best. Yeah, that's probably one of the
Dude.
best salty snack
I've
foods
never heard
out
of
there
that.
for like watching a movie and eating some Pirates Booty.
Yeah.
It's good.
Nah, I want some other booty when I'm.
It's white cheddar. The white cheddar.
Dear God, that
White
doesn't make
cheddar.
anything better. Good God.
Okay.
Blech.
But yeah, I see what people are saying though. The traction here is cocoa prices are starting to come down, or normalize, and then you have multiples trading at, compared to historical levels, it's on the lower side of things. So all in all, I think it looks like an interesting opportunity. It does.
Yeah, it does.
I think it looks more interesting than Pepsi, even though I've stated that Pepsi I think is a better business. I think from just like where the valuation is and what the forward growth might be, Hershey's looks like it's a little bit better. The balance sheet's also really good. It's under levered. It could get more levered. What's going on?
Oh my God. Chat knew where I was. Yeah, Chat already knows.
They're doing like a dodgeball session.
Like,
We're gonna lose Jesse.
you said it would only be an hour.
Bye, Jesse.
I gotta go. But no, yeah, Hershey's looks kind of intriguing. So
We can definitely talk about this more. on
Yeah,
later
so
days.
Hershey looks good.
I gotta go
anyways.
pick
I'll
up some
go
ping pong
get-
balls.
Are you playing beer pong?
Bye.
Nice.
Thanks, Jesse. Bye.
Later.
Oh, that's great.
That was
Okay. Yeah, I could see myself kind of adding it to my boomer collection. That was fun.
That was fun.
Oh, so we got some good questions coming in. So, can we get a Disney update? Is Disney dead? All right, I'll ask the panel. I mean, can we get a Disney update? Sure, you guys can get a Disney update. So I currently have no position in Disney, but may re-enter position in Disney. So I haven't really. I view it as potentially a distraction from other opportunities, but because really it was a play to originally see if the proxy battle could go in favor of Nelson Peltz, because a lot of the changes he wanted, I think, were really good. But Bob Iger won, and that was my exit initially. I re-entered very briefly and then exited once again, day traded Cope and Seath. But in all seriousness, the play here is like you have a business with management that won't get out of its own way. Wonderful assets, undoubtedly, and very strong IP. But again, just terrible, terrible execution, abysmal execution. I view them now, unfortunately, sad to say it, as a lower quality business than many of their peer group. Netflix is by far and away the best. By far and away the best. Netflix doesn't have the parks. But Disney's better than Paramount. Disney has Disney has a better balance sheet than and especially relative to earnings than Warner Brothers.
Also
I'm sorry.
low bar. No, you're not. But also low bar.
I'm gonna meet with Jay Nagy soon, so we can talk about that. I'll make sure to bring it up. How about that? So, what about Philip Morris? What do you guys feel about Philip Morris? Oh, wait. Sorry. Before, I don't want to leave this guy without answering his question here. The one big question for HSY is, will revenue drop? I say yes, with inflation coming down. Prices won't go back down, though.
Inflation going down just means prices aren't going to keep going up.
Yeah.
Like
prices won't go back down.
You're
not going to. I don't think you'll have disinflation.
Yeah.
No, that's what it is. We have disinflation. We want.
I'm sorry. I'm deflation. We're not going to have deflation. We're having disinflation.
Yeah. If we have deflation, hope you have some bonds.
hope you own a house.
Bonds. No.
No. Own a house with a great mortgage.
I hope you own your house without a mortgage.
Oh, sad.
Yeah.
No, well, to be fair, if you have deflation, you're in a pretty serious recession. So it's like, I hope you still have your house.
If you have a house without a mortgage?
No, I just hope you still have a house.
You blowing up the house?
No, like you lost your job and got kicked out of the house.
But if you don't have a mortgage, then it's just the government kicking you out for your taxes. Because you are paying rent to the government, by the way. Forever rent. You don't actually own the land. Everything's a lie. Owning a house is a lie. You're always a tenant. Wake up, sheeple. Sorry, I just had to.
How do I become truly free?
You have to actually. You can own a farm.
But you still have to pay taxes.
No, there's property tax exemptions, or in many states it's just like super low. Yeah. But in many places it's like exempt. Yes, and so you actually own the land. But no, if you own a house, you're still always paying rent. You want me to prove it to you? Stop paying your property tax. See what happens. They'll evict you. And not only that, they'll put a tax lien on it. And they'll sell the property, and you won't get a penny. Some investor will buy it off of you. But by the way, that's something that like real estate lawyers would do, because they would have access to the lists before anyone else, and there'd be pretty horrific instances of like elderly people who forget to pay their property tax. Forgetfulness, happens. They don't pay their property tax. The government puts a tax lien on the property. They scoop it up and then they evict them. Or they say like, you have to pay me rent. I own your house now, or I'll evict you. And it's like a lot of times the victims of the government's taxation in this case is these elderly people.
And that's why everybody loves lawyers.
Nobody gets evicted. No. You don't have to pay your landlord, but you have to pay the government. They'll evict you. They will definitely evict you. So nobody should be allowed to own property, TBH. Well, no, only the state should, and I should be the state. So I should own all the land. We should go back to the king system. I think the king system's fair. You know, the
Oh,
king owns all,
monarchies.
and we just all rent from the king. Same thing. What happened,
Uh-oh.
Andrew? Tiffany.
Uh-oh.
Oh my god.
No, there. Oh, no way.
What's wrong,
happened?
Andrew?
I'll tell you guys off. It's a good thing.
Oh,
Is it
I know
related
it.
to a victory lap?
Victory lap that's up and coming. Yes.
Yeah,
No,
I
no,
thought-
it's not victory lap
Okay.
at all.
Cool.
It's an investment that I've been looking at along with a member, and I didn't realize that someone else who's in the investment is someone who has a very good track record that we had found another investment through. Yeah, I'm just gonna put in private chat.
The suspense. I'm sorry, viewers.
I'm so sorry.
If
viewers,
you're in the community, then you'd know. But
okay, so okay, Tesla, this part, yeah, Tesla taxis, right? Killing Uber. What do you guys think about that? All the Tesla coping and seething, it's up a lot. I count myself among them, by the way.
wait,
I own no Tesla.
why is Tesla killing Uber?
It's not, but it's the theory that
Robotaxis.
robotaxi will kill Uber. Yeah.
Yeah, but Robotaxi, has there been a release that it's out now?
No. And back when I had a Tesla, it wasn't very good. Like the self-driving wasn't there yet. But yeah. Elon followed Uber CEO, didn't he? What does it mean? Oh, we can talk about SQ. I'm starting these questions because we got a builder, SQ, but we got to start wrapping up because we're approaching the 2 hour
Let's
mark.
wrap it up. Let's wrap it up.
So we'll go through these questions. So builder, thoughts on builder?
Watch list.
Watch list, fair enough.
I agree. Watch list.
Watch list.
Yeah,
and
because we
then-
talked about it last live.
We did. Infrastructure. Anything on infrastructure changed in your opinion?
Infrastructure, other than the price of the stocks getting cheaper, so you can buy them up.
Yeah.
No, I think people are worried because of Trump.
That's stupid. If that's the reason, buy infrastructure.
No, that's what people are worried because there's a worry that Trump's going to change the infra package. He's not going to. Dude,
No.
these presidents don't change what people think they do.
Yeah.
But like it's the same thing with the positive sentiment for like private prisons going up. Infra went down. Right? It's two sides of the same coin.
Yeah, no, I'm just reading your message.
I put it in.
Oh.
Here, I'll tag you in where I put it in the. There you go.
That's it. There it is.
Mm-hmm.
Okay. All right. Anyways. KKR infrastructure is the way to go. Well, you're talking to a very big KKR bull, not me, but Andrew over here. Very bullish KKR. But KKR infrastructure definitely will do well. Okay, so then the question here that we just got. Square. Thoughts on Square? It's you know what? There was a time where we said, I'll let you guys in on the joke. We said, you know, there's all these like cult stocks out there, and you know, all these channels these clown channels that are like surrounded by one stock, whether it's SoFi, PayPal, etc. And they're all fintechs. Robinhood. I was like, there's no Square. Square doesn't get enough love, so we need to create our own cult. We called it for temporarily the Blockheads. We had our own symbolisms and mannerisms, and you know, we didn't really take off because I didn't really take it too seriously. But I think we should take it seriously. I think we need to start the cult. Of which I will be the supreme leader, of course. And I'm going to request that everyone pays me about 20% of all unrealized gains. So it's a form of tithing of sorts. But yes. I was going to think of another thing. You know, maybe I get dibs on certain things. But anyways, we'll get to that when we get to that. So SQ, thoughts on SQ? They have the superior in the competition between them and Venmo, I think Cash App is superior. The one problem I see is what Hindenburg pointed out, because I think it's a legitimate concern. It's concerns about them enabling criminal activity or criminal behavior, and what that could mean as far as liabilities go for Square moving forward. But I think the product is very good. You can buy stocks, you can do crypto if that's your thing. I think as far as like sending money goes, it's the UI is very good. But I like that it adds different features for someone who's underbanked, and Cash App goes for those underbanked people. You're giving them a lot of different banking features that they otherwise wouldn't have access to. And I think it's done more positive than negative. Crypto could be a separate debate, but it's like giving people access to buying stocks fairly easily. Great thing. Giving people access to, sending money, checking account, quasi checking account, quasi savings account. Great. So I think all in all, that's the positives. They have a great cash cow in the terminal business, the POS business. Terrible acquisition in title. It appears as though the CEO did that just to get close to Jay-Z, which is kind of questionable. And I think there was one other acquisition, but the terminal POS business with Cash App, great. The other stuff, questionable. Just my 2 cents there. Valuation wise, I think if you're looking at forward growth, it actually looks cheap, believe it or not. But the reason why it's cheap is I think the Hindenburg issues. That's the only reason. So forward growth, it looks cheap. Undoubtedly, I'm not going to argue there at all. So if you're not concerned about the issues Hindenburg put out, you're not concerned about the acquisition of title and what that could mean going forward, if those aren't in your purview, right, of concerns, then honestly, I won't fault you. I think it has, for what it's tackling and what it's focused on, I think it has a better trajectory than something like other fintechs out there that have a challenged story ahead of them, where their core business might not be getting attacked. Because the POS business, I think Square is actually dominated there. They might be getting attacked on the edges by something like Toast, but as far as it goes, there's still a lot of market share to take away from legacy players. And Toast isn't really getting into the all-inclusive product yet. They're focused restaurants, hospitality, and while what I've heard is that people really love Toast, Square can still take away market share from First Data and the like, and they can fight with Clover. So
maybe you said this and I missed it. The only thing I'll add, I think you summarized it well, but unless your account's very small compared to your portfolio, you're an idiot for being 100% invested in one single stock like this.
Well, the person say they were 100% invested?
Didn't they?
I didn't read that part. Oh, yeah. Well,
you can be nice, helping mean. You're an idiot. Please, unless you like, this is a very, very, your like account's very small and you make a lot of money and like it's a very small part of your income. This is a very, 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 very foolish way to invest. Do not go all in 100% on one growth name. It's fine to be invested in it, but 100% is.
Yeah, because something could happen, you get wiped out, and then you start all over. And if you're not making a lot of money, to like your replacement income is really high, or your replacement threshold is really high, that could be tough.
I know he's saying it's a joke. Please highlight Dividends Dude's comment. Process versus outcome.
This?
It doesn't matter if you're right. You're still an idiot. Like, process versus outcome. It doesn't matter.
Could be a troll though. I don't know.
No, I think he's joking.
I hope so. Like there was also
okay.
Because there was also the comment earlier that Jack Dorsey's genius is underrated or something like that.
Okay.
Yeah.
Okay.
No. There's some people who actually like Jack Dorsey.
Yeah. Oh, don't get me wrong. Yeah. Like, but.
Yes, you need VT, VU, VTI, QQQ,
No.
SCHD, SCHG, That should cover pretty much most of your bases. And then, add in some small cap ETFs in there. And just for some added income, some added oomph, go for some Ulti. Probably Ulti or YMAX. Then there you go. Then you have all your bases covered. VT is not diversified. It's only one stock. So you got to be careful. I have to do the wink thing because some people won't get that that's a troll. This is funny. There is so there is actually a case for doing the one of the S&P 500 and then one of the ex-US funds because of the expense ratio being lower. The net expense ratio when you added the two and weight them, it will be lower. And then you can mimic VT, and you don't have to do anything fancier than just contribute to the one and allow them to weight each other, but based off the performance. So you only have to do the initial weighting, if that makes sense. So for example, you look at what is the current weighting of VT, US international, and then you do it, boom, right there. And then now you have your weightings. But then now when you go to contribute new capital, you're letting the market decide your weightings. And so whatever it grows to as far as the percentage of the portfolio, you just add that percentage. But then you get into the complexity of well, this is assuming you can resist the psychology of deviating from a VT allocation. But yeah. Anyways, Andrew, you were going to say something because you're thinking about something.
I don't remember what I was going to say.
Good luck.
Now I'm more interested in this stock. Actually, I want to probably sit down with Lucas and go through it.
One?
The one that he was talking about.
Oh,
Yeah.
okay. No, fair.
All right, so we'll start closing up. Okay, so if there's any other last minute questions, Stabula.
Yeah, good old Stabula.
Jake Dorsey founded two multi-deca-billion-dollar companies. How is he not a genius? And he still leads SQ and owns some of the shares.
Makes you wonder because of his entire net worth in Square.
Still, I would say he's probably very visionary. But once they get to that point, I don't think his competency is actually running a large business.
Yeah.
Twitter never made money.
Yep.
That
and also the whole founder thing. Let's be honest. A single person founding at least that one. What was the other one that he founded? Was it Square?
Yeah.
Yeah, because Twitter's got many founders.
Yeah. Sorry, I'm just.
Yeah.
No. We're gonna go.
The comments get me sometimes. That's all.
Mm-hmm. Still holding the CCL options? No, I already took profits on CCL options. The only ones I still hold are actually the puts leg. So I still hold the puts leg. I'm fairly okay with holding that for a little bit longer, allowing maybe the price to go in my favor, more in my favor, or theta decay. So, but I don't hold the calls. That's what you're asking. So many leverage people's money. Warren Buffett is making a good point, though. No, I think it also matters about they have I know you're joking, right? But they've reached a certain level of wealth where you're unkillable, and so even if the number's not 99, but let's say it is 99%, 1% is still more money than someone could really need to at least live comfortably. So having that amount is fine.
That one stock is practically an index unto itself.
Can we answer RK?
This one?
Yeah, I think that's a good question. Thoughts on Autodesk relative to other big pure software names? Got a pretty large position from RSU. Okay, more management, time to diversify. They've had like some accounting issues and everything. I think Frozen IKEA knows it pretty well. I haven't followed Autodesk that well, but if you're somewhat like nervous about it or not feeling good, especially if you have, especially if you work there already, I don't see why you wouldn't potentially look to diversify. Potentially, you don't have to sell it all, but if you want to sell some and put it into the market, like you could, of course, there's also taxes to go with that. So, you have to recognize gains on whatever you have, and then, so I still think it's worth it to diversify. You don't want to have all your net worth tied up to a company that you're already working at who's had some kind of funky accounting issues and just like questions in general. I don't know the details. I don't think you have to sell everything, but I think it's always good to diversify.
Yeah, because even if it is a clean, well-run ship, like, God forbid anything happens as far as, I'm not wishing that on anyone either.
Yeah.
But...
No, for sure. All right. So snap-on question. We can address that next live stream if you ask it again. The question on KHC, we can, same thing for you. So if you have any other questions, just feel free to just come on the next live stream, ask your questions, and we'll try to get through them. So with that being said, thank you guys so much for joining in today. And if you guys are curious about the club, you guys can check the link in the description below to see if you want to join the club or not. And with that, I'll leave you guys off. We'll see each other again next week. I hope it's for the Victory Lap live stream because that one's going to be really fun. A really good case study. Fun. Very fun. Honestly, but yeah. All right. So I'll leave you guys off with the Bill O'Reilly exit.
Okay. We'll do it live. Okay. We'll do it live. It. Do it live. I'll write it and we'll do it live. Thing sucks.